All right, welcome back, traders. John Caruso here. It is Sunday evening, January 8th. We're going to recap last week's trading action. It was pretty action-packed in terms of the data. We did have a pretty good range to trade in the S&P 500 for the better part of last week, or I should actually say for the past 11 sessions. We've been in a consolidation range. It's been about a 100-point range from 3,800 on the downside, 3,900 on the upside. A lot of chop and a lot of trading. Good ranges to trade over the past 11 sessions, but it doesn't look as if we are attempting to break out on the upside out of this trading range that we think could carry us potentially into 4,000 one more time before once again we see another big period of risk setting into the market out into February, March, and April timeframe. So let's review last week. We did see the S&P 500 up 1.5% for the week. The Nasdaq was up 1% on the week. Russell 2000 led the way, and the index is up 1.79%. 10-year yields did fall 19 basis points. That's very interesting. We actually do think with yields coming in and the pop we've seen in bonds, we actually do think that there is going to be another short selling opportunity in the bond market coming up here relatively soon. Of course, looking forward, we do have Powell speaking on Tuesday, and then once again we do have the CPI reading that comes out on Thursday. So there could be some short side setups in the bond market going into those two pivotal reports coming up this week. Energies fell flat on their face. Crude oil was down 8.5%. RBOB was down 9%. Natural gas continued its crash. It's down 40%. Since the beginning of December. Nat gas was down another 16% last week. The metals are behaving very well right now. Gold up 2.5%. Silver actually did decline on the week, down 0.18%. However, we did see a late week recovery in the silver market as we move into a very seasonally strong period in silver throughout the rest of January and into February. Platinum up 2%. Copper was up 2.89%. We did do a special report on the copper that we sent out to our traders last week. We did see copper actually break a minor swing low at about 272. I think that was on Tuesday or Wednesday of last week. And then we've just jackknifed higher in the copper market. We are approaching $3 a pound right now in copper here on Sunday evening. I believe we just opened up right around 297 or 298 in copper. So taking a look at some of the data last week, we did see ISM Manufacturing Purchasing Managers Index slow to a recessionary 48.4. We did see a modest decline in the JOLTS report on a month-over-month basis, but very modest, nothing to the liking of what the Fed is likely want to see in terms of job openings coming down. ISM Services PMI did show a contraction to 44.7. That's down from 46.2 in the previous reading. And then, of course, on Friday, we did see the non-farm payrolls report come out, of which many are describing as a Goldilocks style number. We saw strong jobs growth, 223,000. That was above the expected 200,000. However, it was a little bit inside of what we saw in the previous month of 256, but still pretty strong jobs growth nonetheless. However, we did see wages start to show some signs of decline. We did see year-over-year wages decline to 4.6%. That is down from a revised 4.8%. So we did see the revisions actually lower as well. Month over month, we did see 0.3% wage growth. That is down from another revised figure of 0.4%. And of course, the unemployment rate did actually decline to 3.5%, down from 3.7%. But I think that has more to do with the participation rate of the market. So all in all, it was viewed as a Goldilocks number. We did see the big stock market rally on Friday. Pretty much, we saw a little hemming and hawing off the open, but for the most part of the day, we spent the day on the upside. And here we are on Sunday evening. We do have the S&P 500 trading well north of 3,900 at 3,922. So it's an interesting situation why the market was kind of viewing that jobs number, that Goldilocks number, as a positive. I think the glass half full argument is the idea that wages are slowing, therefore inflation is going to slow even further from here. but the glass half empty, and I think the more realistic view to take about Friday's the takeaway from Friday's jobs report is that declining wages means the consumer is weakening, which ultimately will lead into corporate earnings and profits declining, which ultimately weighs on U.S. GDP growth. And of course, that is our forecast for the first half of this year, is that U.S. GDP is likely on the precipice of falling off a cliff, as well as corporate earnings and profits, which of course we've got the earnings season coming up here in the next over the course of the next several weeks. So let's get to the charts here. We're going to show you what we see. We're going to look at 3 or 4 charts here this evening. Of course, here is the March S&P 500. You can see this 11-day consolidation range that we've been chopping in and out of. And then we had the big impulse higher off of the jobs number on Friday. Here we are this evening, 39.22. Perhaps we get a little wiggle down in here early. But ultimately, we do think the market's going to try to chop its way up into this downtrend line that comes in right around 39.60 at the minimum. Perhaps we get some overshoot into the 200-day moving average right around 39.90, and perhaps a little more overshoot up over 4,000 to 4,025. Of course, we had the overshoot here after we did see that retest of the downtrend line. Big overshoot, in fact. Market spiked to 41.75. Massive failure. Consolidation ensued. Perhaps we get another retest of this line here before yet again we've got forecasted another failure out into the end of January, and then February, March, and April is a period that we have pegged for extreme risk in the market. And that could potentially, that period from February, March, and April could potentially deliver the final leg of this bear market for the remainder of the year. So we're gonna be very mindful of that. We still think there's plenty of shoes fundamentally that still need to drop. Number one, corporate earnings and profits we think are slowing. We think Wall Street's estimates are still too overly optimistic for 2023. So we're going to start to see those estimates come down. Of course, we're going to report earnings. Fourth quarter earnings are going to be reported over the next several weeks. We're going to see what those look like. And then, of course, going into the second quarter, we're going to get first quarter earnings and so on and so forth, which we think are going to show some extreme stress. And then, of course, U.S. GDP, the growth figures, we think that those are ultimately going to slow. And then, of course, the final shoe to drop is usually typically employment. We still have a very tight labor market. Of course, we know that the employment data is one of the most lagging indicators that we have in all of macro data. And that's why we think it's actually a mistake that the Fed is keen so much on the employment, the rate of employment. I actually think it's akin to what we saw back in June of 2021, when the Fed actually should have pivoted and started to get a little more tight, taking away the punch bowl, taking away the quantitative easing, and setting us up for interest rate hikes in the fall of 21. But no, they were keen off of the elevated rate of the employment market, which again is an extremely lagging indicator. And that's one of the main reasons why I think the Fed is in the position here today, being behind on inflation. And I certainly do. I am concerned that the Fed is paying too close attention to the employment rate right now. And we might not start seeing the employment rate start to jump for another 6 months, where you start seeing extreme job loss. So very interesting. I think it's a big problem. I do think the Fed needs to recalibrate as to how they're looking at things in terms of the employment data. But that's neither here nor there. So just to recap again, little chop in here. We're going to probably try to chop and test the upside, 39.60 to 39.90, maybe as high as 40.25 before another extreme period of risk. I actually do have an immediate term overbought signal here that registered on Friday. We did actually use Friday to start recommending some very small short side positions once again in the equity space. Small, I can't stress small enough, because we still think there might be a little more grind, but of course nothing is going to be perfect. And of course nothing is ever set in stone for the market in terms of our analysis, but still have a big period of risk that's coming out February, March, and April. So let's switch over and take a look at What do we have here next? We've got the gold market. Gold's behaving very, very well in here. Clearly saw the big break higher. And then when we popped above the 70-40 level, that was telling you that something was changing in the market. The trend certainly changed in our model. And clearly we've had this nice trading action on the upside here. We were in here over the course of December buying these dips, selling these rips, buying these dips, selling these rips. Had some core long positions that we had on from right around 1788 that we actually got stopped out of on a trailing stop at 1838. So right now we have no gold on the books. And I am feeling the FOMO as gold trades above 1873. But I do think we are going to get into a period. You can see we're stretched. We're on the other side of the top end of the Bollinger Band here. So we are getting stretched up in here. Perhaps we can stretch as high as 61, the 61.8 Fibonacci retracement, which is up around 1900, before we see some more downside here. As you can see how I have it drawn in here, we were expecting some downside in gold. I don't necessarily think we're going to get this deep here on the next dip in gold. The next dip in gold perhaps could be somewhere in here, anywhere between 1820 to perhaps 1800 or 1790 on the downside, we should say, where we think there's going to be another minor rising period. And then perhaps we do eventually out here get that period of risk in the stock market, get that risk off moment in macro that carries the gold market back into that 1740 area, which I think is going to be a tremendous buying opportunity in gold if we were to see those levels once again. But you might have another buying opportunity for a near-term trade if it gets into anywhere between 1820 down to about 1790. So I'm going to draw that in there here for you guys so you can see that. So perhaps we do stretch up into the 61.8. We get a rejection back down in here. I think this trading action is going to be strong enough to support another bounce in gold before perhaps we get a bigger period of risk that takes us back down into that 1740 area down here, which was a key pivot area. And then, of course, once again, we think gold prices are eventually going to trade back well north of 1900 and potentially make a new all-time high at some point in 2023. So that's a look at the February gold contract. We remain very bullish on gold, and can't stress enough that weakness, we think, is going to be bought throughout the course of this year. We're going to flip over, take a look at copper. I did some work on copper last week. Special report. We put that out to some traders. Copper actually had a little breakdown here, broke this minor swing low. I think what that was doing, it was shaking out a lot of the managed futures long positions that were in there in copper. I think it shook a lot of those CTAs managed futures positions out. A lot of stops were triggered with that break of that 1372 swing low. And sure enough, we get a jackknife higher. I do have an overbought signal up here, so I would not recommend chasing copper. However, we are breaking above these peaks up here, this 395 area, which was which has been a pretty good lid on that market. So very possible that we carry into the next fib number, which is up around the 50% fib, comes in about 409. Lower probability, I think, in the near term that we get to the 61.8, which is 432, but certainly anything is possible. Copper, the structure that we're seeing in here, I'll actually show it to you on the weekly. Let's get the weekly chart up here if it'll pop up for me. This trading action that we've seen in copper over the past several weeks. Waiting for the data to load. There we go. So this trading action, clearly we had the massive rejection down here at, up above at $5, which happened back in March. Bear market trading ensued. Then we saw this sideways chop meander with this upward bias. This almost looks like a sloppy inverted head and shoulders in here. But it certainly looks like a base to me that could take copper into that next leg higher. Like I mentioned, potentially as high as 430 when I look at the weekly chart before we see another period of risk that sets in copper prices. But right now, over the near term, copper prices, the bulls certainly are in charge of that chart and could potentially try to squeeze us back above $4 here over the very near term. Taking a look at crude oil. Still not a fan of crude oil here. Clearly, bear market trading has ensued. We heard all the calls for $150, $200, $250 a barrel based on the tight supply fundamentals. But clearly, crude oil has other plans in mind. We've even heard, obviously, China is now reopened to the rest of the world where they're allowing travel to and from China. And that clearly has not had a positive effect on price either. So clearly, bear market right now, channeling lower. I did get an oversold signal down here last week. So perhaps we try to chop and grind our way back into about 78 to maybe 79. But I ultimately think this market's going to fail once again and potentially give us our final leg of this, we'll call it, 7 to 8 month bear market trading that we've seen in the crude oil market. Perhaps that's the final leg. Takes us into about 66, maybe 60, and perhaps we start building in a base or a bottom in crude oil. So that's a look at what we've got going here on the charts. I want to wish everybody the best of luck out there. If you have any questions, feel free to reach out to me at my email, jcaruso@rjlfutures.com. If you want to jump on our morning market insight letter, I'd be more than happy to add you to that for a trial, 30-day trial. You can see what we're doing inside of there. Best of luck to everybody out there. And remember, trading futures and options carries substantial risk and may not be suitable to all investors. Best of luck. Talk to you soon.